And great to have you, DK.
Nice to see you. It's been a long time.
Yes, it has been too long. As we've said many times, we look forward to having you back at the desk. How does 47 hold, your forecast?
Well, it's a challenge right now. The issue is earnings have been better than expected. Earnings during the first quarter up year over year around 10%, and coming into the quarter, we're looking for something around up 5%. So we've had better earnings, but the financial environment has changed pretty significantly. We've had bond yields go up dramatically, both nominal yields, 1.5% start of the year, now 3%. Real yields negative 1% just 8 weeks ago. Now they're about 25 basis points to the positive. Credit spreads have widened. The dollar strengthened. So all these are part of the tightening financial conditions that was anticipated, just been much more than we had expected. So there's sort of a scenario analysis of a recession, not in our forecast, but that's would put the market like 3,600, and we're much higher, if you will, in a more benign environment. So that's the market seems to be trading those range for a long time was sort of 42 to 4,600, a little bit below that right now. It's been pretty challenging. Talking to portfolio managers, they've been sort of different minds. Some believe that the economy is going to tip into recession. Others believe, as the Goldman view, is that the Fed, it's not inevitable that there's a recession, and in fact that the Fed can slowly tighten the conditions, and we can kind of avoid that downturn.
Certainly what Williams said this morning, that there is a path to a soft landing. We had Jan Hatzius, your colleague, on Jobs Friday last week, and he's holding to his view of peak inflation, but I guess peak means different things to different people.
Right.
It can peak and plateau, or it can peak and back off. How much does that matters to how the market feels?
Well, I think the three numbers to keep in mind are 11, 6, and 5. It's 11 million available positions. There's 6 million workers looking for jobs, and that's a deficit. Therefore, there's more jobs than people, if you will. It's about 5 million. And so the idea, economically speaking, is the tightening financial conditions have to cause companies to pull back on some of those open positions. So that's the economic story. But from an equity market point of view, if you can achieve that, then you have relatively financial conditions will already have tightened sufficiently to let that happen. And the equity market, therefore, would be matching more of the earnings trajectory looking forward into next year. And so that'll be the positive argument, or the kind of central case that we're assuming is that earnings will be driving the market looking forward. And I think then it leads to the idea, Carl, is inside the market, where does one invest? That's really been the discussion point.
So David, it's Morgan. Where does one want to invest? And I guess just in terms of more broadly the market action, what are the signs to watch for in terms of a bottom?
So the key strategy, a couple of key strategies. One is dividends. And so, Morgan, the idea of companies looking at their cash flow and distributing it to shareholders, I think, is a key aspect. If you think about the overall equity market, you have earnings and sentiment and money flow and positioning that would drive the multiple. So there's sort of earnings and multiples. When you're looking at dividends, it's the capacity of a company to actually pay the dividend, cash flow, and the propensity or willingness of management to distribute it in that fashion. So if you look at some of the companies, Amgen, Pepsi, United Parcel Service, those companies have above average dividend yields and dividend growth. Those are also companies that the Goldman Sachs analysts respectively have a buy recommendation on. But the intuition is that in an environment where there's concern about valuation, dividends that's not a variable in the discussion. It's basically the payment of those cash flows. And if you think about it, another way is that the market trades right now in the swap market as though there is dividend cuts in 2023 and 2024. Our view is you've got 10% dividend growth this year, another 9% growth next year. So first strategy, thinking about dividends. Another would be thinking about the stability of growth. And so we've been discussing just a minute ago, or here with Carl, I know you're on the camera, the other end of it, is the idea of how stable the economic environment will be. And if you're looking at companies where there's a sort of stability in their EBITDA growth looking over the last decade, that's sort of prima facie evidence before the pandemic, during the pandemic, post-pandemic, they've been able to deliver pretty strong growth. Those are some of the attributes we're looking for right now.
All right. Some actionable names there. Our viewers, I'm sure, are going to appreciate that. Just in terms of the S&P more broadly, though, does it have further to fall? And just in terms of trying to suss out a bottom, what are some of those key factors that you'll be watching for?
So the idea of rates, and real rates in particular, sort of a expectations of bond yields and adjusted for inflation. So we have real yields now basically around positive 25 basis points. As I said, there's been a significant move in the last 8 weeks alone. And the view of tempering that and the idea of real yields kind of staying in this area, that would be one variable, Morgan. The idea of nominal bond yields as well, around 3%, having them stay kind of in this vicinity. I think that's a key aspect. Inflation coming down would be another variable. We'll get a print tomorrow, among others, and the idea of some evidence that there's been some peaking and maybe perhaps slight moderation in the pace of inflation. That's another variable. So rates and inflation would be the two drivers that we're looking at. Because right now, the earnings front have held up extremely strongly. Companies, both on the top line and on margins, have been pretty effective in managing through what's been a challenging economic backdrop.
There's been a couple calls from some of your peers around the street. One I'm thinking of last couple weeks was to go long the 10-year, targeting 2.25. Is that too extreme for you?
That would be not consistent with the view that we would put forward. And the idea behind that is if the Fed's objective, arguably, is to tighten financial conditions, an equity market that rallies a lot or bond yields that come down a lot would be sort of antithetical to that objective. So it's kind
of the dynamic we had last Wednesday after the presser, right? They don't want to see too much given away.
Right. And the idea is if there's, arguably, the Fed has done a good job navigating tighter financial conditions. It's obviously been painful in the equity market and some of the other financial markets. That's sort of come down. And our view is that's at a level where there's still attractive value in the market, looking out over the sort of intermediate term.
One other thing I saw yesterday was an idea to short some utilities because, according to Trivariate, 20% have dividends that exceed net income. Is there risk in chasing dividends right here?
There is, and one of the ideas of dividends is what's the payout ratio. That's where your vulnerability. And so, group of stocks we look at with a dividend payout ratio, share of net income around 40%. The typical company right now, on average, is around sort of 30%, a little bit less than 30%. And so payout ratio, that's a share of net income. If you think about where the first adjustment is going to be, if a company was challenged, it would be buybacks. Buybacks would get pulled back. Dividends are likely to be more sacrosanct. Companies are very reluctant to want to cut those. So you would see that buybacks would be more vulnerable. And that's been a big source of demand for shares right now.
Well, if not one of the biggest, right? Yeah. David, appreciate that. A good roadmap for what's been already a crazy start to the year. Good to see you.
Thank you.
David Kostin of Goldman Sachs.
Shepard Smith here. Thanks for watching CNBC on YouTube.